My name is Eric Getty. I'm Vice President of Government Affairs here at CBIA. So over the past 9 months, we've seen some of the most significant reforms to the federal tax code in years. And while many of these federal reforms were beneficial, the loss of certain state and local deductions would have had a significant financial impact on many of Connecticut's small and medium-sized businesses. But thankfully, a handful of lawmakers, our friends at the state's Department of Revenue Services, and representatives from CBIA member companies were able to work together on a new tax arrangement that would help minimize the impact of the loss of these deductions for most businesses. And change is often difficult, and in this case, it's no different. But to help us understand these changes, we have asked 3 or 4, actually, of Connecticut's foremost tax experts to come here today to help us all better understand this new pass-through entity tax. So I ask you all to please help give a round of applause and welcome Alan Lieberman, who's the managing partner at Shipman and Goodwin, along with his colleague David Bigger. We also have Tony Switajewski, who's a partner at BlumShapiro, and Matt Dayton, who's counsel with the Connecticut Department of Revenue Services. So let's, again, please give them a round of applause.
Thank you, Eric. We're going to spend the next 90 minutes, and I apologize, it's a little bit wrapped around the corner here, going to be sort of exploring a whole new world here in Connecticut. As Eric rightly said, the intent here was clearly to try to create a benefit for Connecticut taxpayers, but for those of you burdened with having to comply with this new law, it takes a little while to do, but in fact, we're going to try to demonstrate to the extent we can that ultimately, at the end of the day, that's the intent of this legislation. Obviously, we have had a business entity tax, but that's kind of almost a fee in most regards. This is the first time we're entering a brave new world where Connecticut, for the first time in many years, has imposed a tax on unincorporated entities, in particular here, partnerships, S corporations, and LLCs, taxed as partnerships or S corporations. The first thing I want to sort of get right off, make sure everybody understands, we don't have all the answers. This legislation was passed literally on the last day of the session, and I think the DRS would agree with us that we are as much working to make sure that we know all the questions as much as we know all the answers. The DRS is still in the process of putting together guidance under the new statute and soliciting from the taxpayer and tax practitioner communities input in terms of the issues that they see. And this forum, as other forums that we have spoken at, is an opportunity for us to do so. We're going to go through the tax. Tony Swit is going to start by giving us a little bit of background on sort of how we got here and what we're going to actually try to cover during the next 90 minutes. But we invite questions and comments. Just a couple of preliminary notes. First of all, the deck is a creation of Tony, David, and myself. It is not a statement by the Department of Revenue Services. We've asked, and Matt has graciously agreed to be here with us today to provide insights from the DRS, but again, his positions, I think, are...
Yeah, and I'll jump in briefly there too as well. My positions here, are accurate to the extent that I believe they are, but certainly the guidance that we issued is what you should follow. I mean, do not take my word as gospel. Do not take this deck as gospel. I guess as close as gospel as you're going to get is going to be the official guidance that DRS issues on our website as time goes by. We have a few items that we've issued already, and we're also in the process of issuing more. So those are the documents that you should rely upon, but I'm sure that this panel will provide great advice that is consistent with what likely will be issued as our guidance.
Right, and we will review all of the guidance that has been issued and raise questions with you in terms of things that we hope will be addressed in future guidance down the road. But as I say to you, it's an evolutionary process. We very much want you to be part of that. So feel free to ask questions, whether you feel comfortable doing it in this forum or want to come up to us afterwards during the break. We'll be here to do that. So again, your input will be very helpful here. So as I said, we're going to start with Tony, sort of setting the stage here, letting you know what we're going to cover, and telling you how we got here in the first place. So, thank you.
I'm just going to sit here if that's okay. So again, this is our disclaimer. So this is the agenda that we're going to try to cover today, the topics we're going to cover, me, myself, Alan, and David. We're going to cover a little bit of background of the Tax Cuts and Jobs Act limitation on the state tax deduction, which is what got us here today with the Connecticut's response to that. The PET, we call it the PET, that's the pass-through entity tax. We're going to talk a little bit about the taxable income base of calculating the tax. There's basically two methods. There's a standard method and an alternative base method. We're going to get into some detail. The different methods produce different results. A little bit about an investment income and how that is treated for this tax. We'll also talk about a little bit about tiered pass-through entities, where you have one partnership that owns another partnership and so on and so forth, and how that's treated. There is a combined return option for this tax. If you have two related pass-through entities, they could potentially elect to file as one entity, basically, or a combined return. So there's that possibility. Net losses, there's some net loss carryover provisions. We're also going to talk about the pass-through entity owner credit for the PE tax, and that's the credit that will go on to the owner's individual tax return or corporate tax return. A little bit about how you allocate that credit and the deduction. The estimated tax payments, there's now going to be estimated tax payments required for pass-through entities, and we'll define what all this is. There's something called recharacterization of estimated tax payments. We're going to cover that. Resident credit for entity level taxes paid to other states. There's some potentially beneficial credits that residents could get now. The non-resident credit for PET in resident state, the applicability of that. PE tax enforcement, the financial statement impact, GAAP, and the Connecticut tax guidance. So you can see there's a lot of different topics here we're going to touch on briefly to make you aware of, at least. We're not trying to make you tax experts in this, but you should at least know what's going on, so you can go back to your tax advisors to speak to them about it. If you have any questions, feel free to ask them. That is why really Matt is here, so that he knows the kind of questions that are in your mind, so that he can rather address them now proactively, either for guidance rather than having an issue later on. So please feel free to ask. So this is what got us here today: is the Tax Reform Act, Tax Cuts and Jobs Act, that was passed last December. As you probably are all aware, at least in Connecticut and any other state that imposes a state income tax, there is now a $10,000 cap on the amount you can deduct as an itemized deduction. So the most you can deduct for state income taxes, property taxes, and so forth is $10,000. This law is only temporary through 2025. There is some talk right now in Congress to potentially, Trump is at least talking about making it permanent. Not sure if that's going to go anywhere, but right now it's temporary to 2025. Assuming it's temporary, it goes through 2025 and it fails, perhaps at some point then the PE tax might go away. The whole point of this PE tax that we're going to talk about is to provide a benefit to pass-through entity owners, the state tax deduction. Whereas before they would have been limited by the state income taxes that they paid on the pass-through entity income. In effect, they will now get the deduction through the pass-through entity tax. And you'll see, we'll be talking a little about that. So that's really what got us here. It's, like Alan said, it's really supposed to be a favorable thing. It's supposed to be a beneficial thing. That's the intent. It may not work in every situation like that, and there's a lot of complications in the calculation. But that is sort of the whole intent behind this, to put pass-through entity owners in the same place for federal income tax purposes and Connecticut tax purposes that they were in before the act was passed. Dave's going to talk a little bit about a lawsuit that was recently filed by Connecticut, Maryland, New Jersey, and New York on this limitation?
Sure. Last week you may have heard, I have a copy of it here, it's about 100 pages long. The Connecticut and New York, Maryland and New Jersey filed a complaint with the Southern District of New York, the district court, arguing that the Tax Cuts and Jobs Act of 2017 is unconstitutional. Their arguments are largely based on their interpretation of the act as being a limit on the sovereignty of the state, on the federal government's attempts to interfere with state fiscal policy. They argue, the AG's offices for each of these 4 states argue that effectively they have relied upon Congress's history of providing a deduction for state and local taxes since the beginning of the income tax, even prior to the 16th Amendment in 1913. So they're arguing that, hey, we've had 150 years of you letting our residents deduct their state and local taxes in some form or another. You can't now take this away from us. Now, whether or not their argument is anything more than political, I guess is something that we'll have to wait and see. Reading through the complaint, I'm not convinced that it will work, but I've been surprised in the past. So, but this is out there, and this was filed last week. So we'll have to wait and see, how the courts respond to these 4 states claiming that the Tax Cuts and Jobs Act is unconstitutional. So we'll wait and see.
Yeah, we would strongly urge you not to wait to comply with the law on the basis that you think this lawsuit is going to win. But we'll state it as easily, as simply as that.
You can always amend your returns.
I don't want to give it a 0% because that seems harsh, but it's skeptical.
But we want to at least let you know that it's out there. Okay, so just to give you a little very basic background on this. Assault deduction is very conceptual, so the numbers may not be perfect. I just kind of give you an idea what's going on. We assume a Connecticut resident has $500,000 of adjusted gross income, and we assume the individual pays a property taxes of $20,000 and personal income tax of $35,000. Under this very simple example, the individual, if he or she were to itemize, would get a $55,000 state tax deduction, bringing down the taxable income to $445,000. Again, we're ignoring AMT and all that, and exemptions and all that. So $445,000 under the old law. Under the new law, the individual would have $500,000. The SALT deduction would be only $10,000. So you're losing like $45,000 of deduction. So that difference, the $445 and the $490, and again, we're excluding the benefit of standard deductions and those kind of exemptions and those kind of things. But conceptually, assuming you're in a 37% tax bracket, the individual's tax goes up to $16,650 because of this limitation. So the whole point of this PET is to allow the individual to basically get back to the 445, more or less, under this PET. I'm sorry, yeah, so that was the next slide, I'm sorry. So the question is and we'll talk a little bit about this later on, but will the IRS allow this deduction at the entity level? What's happening is essentially, as you can visualize, the income of the PET, of the entity gets taxed at the top tax rate, which we'll talk about, is about 6.99%. You get a deduction for that against your income that passes through to the individual. So the individual is going to, in effect, get a deduction for that state tax that's paid by the pass-through entity, not through an itemized deduction, but basically the number that's going to hit on page 1 of the 1040. So the question is, will the IRS allow that? Because there's been a lot of talk about, ways to get around the deduction and, will this pass muster, or ways to get around the limitation. And in the committee report or the conference report, there is a sentence in there, a footnote, that basically says that if it's a tax imposed on the pass-through entity itself, then the IRS should allow that deduction. They will not tack that deduction, even though you're circumventing the limitation. So we think that the tax itself would survive. The way the credit mechanism works, we'll get into that a little bit later on, there could be some issues there. But on its face, as far as the deduction goes, it seems like Congress would allow it, the IRS would allow it.
And I believe New York City has a similar unincorporated business tax that works similar to how this proposed tax will work, and it hasn't been challenged, to my understanding, in the past by the IRS. So I would imagine that based upon this language, I would give strong support for the pass-through entity tax to survive any IRS scrutiny.
It probably is not the time to talk about the scrutiny of the IRS, but I think that when it comes to this tax and whether or not it will, how it works as a mechanism with the credit that we'll talk about later and the tax imposed at the entity level, some of the things that Congress has done, and I think that the DRS trying to make this work so that no one is paying any more taxes, may cause the IRS to say this is just really a tax that's a personal tax that's being paid by the entity that's a little bit different than what New York has done. And the scrutiny might be a little bit different with the guidance that the IRS has issued at this point, but that remains to be seen. I think as it stands in Connecticut law is that this tax is required. So regardless of how the IRS, I think, responds to whether or not this works at the federal level, at the state level, this is a mandatory tax, and we'll get to that as we go through the presentation. But this independent of that, this is the law in Connecticut right now. So
Okay, so Connecticut's response.
yeah, sorry, we got a question.
Has New York or the other states done something like this to pass through an entity tax to get?
Other states have done different things. New York has imposed as an attempt to respond to the Tax Cuts and Jobs Act. They imposed an employer level tax that essentially adds a payroll tax at the employer level and reduces the tax that the employees would pay on their wages, which is a little bit different approach than what Connecticut has done here. They both could be scrutinized, by the IRS, and who knows, maybe one will withstand, scrutiny, the other one won't. But there are various states in the Northeast, in the Northwest, where states are looking at ways around the state and local tax deduction, but we don't know, if any of them will work or all of them will work.
Yeah, one of the difficulties is we are sort of in this evolving phase, and the IRS response or the federal government's response may depend upon what the states end up doing. I mean, some of us would argue that rather than drafting a 100-page complaint, that they would have been better off sort of getting together and deciding on how they were going to respond, and if they were going to adopt a pass-through entity tax, for example, similar to Connecticut, doing that across the board so that you made sure, particularly for your residents and non-residents, that people are going to be treated fairly from state to state, because the problem is are you going to get a credit for the other states' tax, pass-through entity tax? We'll talk about that a little bit down the road, but it is, if all of the states start doing this as a workaround on the federal level, is that going to, embolden either Congress, or the IRS to take some sort of negative stance against it?
So the Public Act was passed in May 2018, which is in the second fiscal quarter. Payments are due quarterly. I'm just looking at it up there. Has DRS, do they have a mechanism?
Yeah, we're going to talk about
We'll
that.
get to that.
Okay,
Yeah. That's a really good question.
Violation
Yeah.
of our own act.
Yep. Alan will talk about that a little bit later, but that is something to be concerned about, and we'll get into that in more detail. But Yeah, this was Public Act 1849. That was part of a larger act that was even entitled the Response to the Federal Tax Cuts and Jobs Act. So this was one aspect of several attempts by the General Assembly to respond to the state and local tax deduction limitation that was imposed by the new act at the federal level. There was there was a mechanism so that municipalities could set up a charitable organization, and taxpayers could make a donation to a charitable organization and receive a credit on their property taxes. There were several different kind of attempts by the Connecticut General Assembly to respond to this limitation. We're not going to talk about all of those right now. We're focusing on the pass-through entity tax, but this was part of a larger bill. We've given you, hopefully you have our tax alert that goes through many of the provisions that or the legislation that was enacted by the General Assembly that can flesh out some of those other aspects of this act. This was effective for taxable years commencing as of January 1 of 2018, so we're well into the year. And we'll get to how payments will work. As a general matter, this tax is applied to pass-through entities, which are partnerships and S corporations, and LLCs that are treated as partnerships. It is not applicable, to sole proprietorships. Single-member LLCs. Single-member LLCs are disregarded for federal and state tax purposes, income tax purposes. This tax does not apply to single-member LLCs, publicly traded partnerships, or C corporations. You'll see on the slide it says planning point here. We have lots of clients that own single-member LLCs that are disregarded. There's no pass-through entity tax, and as Alan mentioned at the beginning, this tax is intended to be a benefit to Connecticut taxpayers. So it may be beneficial for Connecticut taxpayers to take a single-member LLC and transfer, a percent to a spouse, or do something so that this tax would be applicable as it should be beneficial to them. There are potential planning points here with respect to the entity, but this tax in general only applies to pass-through entities. As it mentions as well, the tax is due on the 15th day of the third month, which is March 15th for calendar year taxpayers. This is when your partnership tax return would be due, and the tax is due on that day as well, subject to the requirement for estimated taxes that we will be discussing a little bit later. As Tony mentioned, this is an entity level income tax. So this is a bit of a sea change for a pass-through entity in Connecticut to be independently subject to tax. Right? This is not a flow-through. The partners or shareholders are not subject to this tax. The entity itself has to pay this tax at 6.99%, which is the highest income rate and the highest percentage rate for the personal income tax in Connecticut. That rate is imposed at the entity level for certain income that we'll get into a little bit later. The owners of the pass-through entity are entitled to a credit for the tax that was paid. So when the entity pays a tax, it lowers the income of the entity that then flows up to the members, the shareholders, partners. Those owners are entitled to a credit based on the tax that was paid at the entity level against their Connecticut tax liability. And that credit is at 93.01% of the tax paid by the partnership, and we'll get into more detail as to how that works. But the intent there is that they would essentially shift that tax liability from the owners to the pass-through entity itself.
Yeah, so at the end of the day, you're ending up realizing sort of a double tax benefit here, because not only are you getting the benefit, hopefully, of the old SALT deduction that you used to get. And in some cases, for higher income folks, you'll get it without having to deal with the alternative minimum tax issue that you did in the past. But on top of that, you reduced your federal income because you deducted that against your federal income. So you're actually paying a little less federal tax at the same time. So there's actually a double benefit out of the end of this.
Which we'll go through some examples, but what should happen at the end of the day is that it should be neutral for Connecticut tax purposes and create a deduction at the federal level by shifting that tax from the individual to the partnership or to the pass-through entity. And in simple circumstances, that's exactly how it should work. But not all circumstances are simple, but you know, that's the intent. So prior to the pass-through entity tax, individuals would deduct on their Schedule A their state and local taxes, right? So their pass-through entity would flow, income would flow up from the partnership. Let's say the individual would pay tax to the state and then would deduct that tax from their federal tax liability on their Schedule A. That is now subject to the $10,000 cap as required by the Tax Cuts and Jobs Act. Now the tax is paid at the partnership level. It falls on Schedule E of the 1040, which is your supplemental income schedule. We don't need to get into all of the forms that are filed, but it shifts this liability from an individual that was subject to the $10,000 cap to the partnership that is not subject to the $10,000 cap. Is treated as an expense of the entity, just like, you know, marketing or, you know, whatever other expense the entity has reduces the income of the entity that then flows up to the partners. So that also with respect to non-resident partners, under the prior act, the entity would file a composite return would withhold the Connecticut source income, the tax on non-resident partners. This doesn't happen anymore because the tax is now shifted, the liability for the tax is shifted to the entity, so there's no withholding required, as the partners are not required, non-resident partners are not required to pay the tax in any case. So there's a little bit of shift there. As we mentioned, the tax is mandatory. This is not an opt-in, it's not an opt-out. Every pass-through entity in Connecticut has to pay the tax if it's doing business in the state. There's no de minimis exception. You have $1,000 in income, you have to pay the DET. There's no exception for any kind of income level. Let's actually skip through it. Some of this we've already covered. Quarterly estimated taxes are required starting in 2018. Alan will get into more of the specifics of how that works. As was mentioned by the question, some of those quarterly payments needed to be made already, so you're all too late, we can get audited. Sorry.
There's a sign sheet for that.
But we'll get into that a little bit later.
And I guess I'll put this out there. I've probably said this enough times on the phone that I can again just state it, that the legislation was passed in the spirit of helping Connecticut taxpayers, and the DRS intends to administer it in that same spirit. So, I mean, we are clearly not going to come after a March 15th payment as being late because the tax wasn't due then. So certainly we understand that there are a lot of changes this year, and it's going to be a lot of questions and confusion, and people are going to try to work through it. So we are going to do our best to administer this tax in such a way that is fair and equitable to taxpayers as well.
Thank you. So as we've discussed, this is intended, the intent is that this will be neutral for Connecticut state tax purposes, that the DRS will not be out any money, and taxpayers in Connecticut will not owe any more tax as a result of this pass-through entity tax. It's intended to work that way. It's also intended to provide an effective deduction at the federal level for the taxes that are paid by owners of pass-through entities. As we mentioned, this does not apply to wage income. This is specifically targeted legislation that is only applicable to folks, individuals who receive flow-through income based on their ownership of a pass-through entity, which is different than what some other states have done. But it is intended for those people to be beneficial and to provide a federal tax benefit. It's intended to be, again, neutral for resident Connecticut taxpayers. It may, however, be unfavorable for non-resident taxpayers. And a lot of this gets to what Alan was mentioning, which is that that may depend on how their home state recognizes the credit that is offered by the state of Connecticut and the pass-through entity tax. If there's no credit at the home state level, then it may create a problem for non-resident taxpayers. And we'll get into some more of the details of how that works. The tax is imposed on either on two different types of income. There's an election here. So it's imposed under one of these two methods, which is the default method, which is the Connecticut source income method, which takes all of your Connecticut source income, imposes the tax at 6.99%. That tax is paid by the pass-through entity, and it's relatively simple. Or the alternative tax-based method, which Tony will talk about here in a minute. But we'll go through the kind of simple approach first, the standard method, which takes the pass-through entity, all of the Connecticut source income of the pass-through entity, and it applies the pass-through entity tax rate at 6.99%. It doesn't pay attention to who the members or shareholders are. You could have tax-exempt entities, you could have corporations, you could have whoever up at the top, and this approach does not pay attention to anybody up at the top. So this is just looking at the pass-through entity itself. All of the income of the entity that is Connecticut source applies the 6.99%. The entity has to pay the tax at that level. If you have a pass-through entity that has non-resident partners, if you've got corporate partners, if you've got tax-exempt partners, this approach is probably not the best approach. This is really good if you have a very simple pass-through entity with all Connecticut residents at the top, then this generally works. But that is not the case for many partnerships in the state of Connecticut. But so this is the simple. This is the default. You have to elect out of this into the alternative base annually. The alternative base, Tony will describe in a little bit more detail, but this actually accounts for which taxpayers up at the top are subject to Connecticut personal income tax. And this will be preferable in most situations. Let's skip to the next slide. So under the standard method, taxable income is determined using your general approaches for partnerships and S corporations to the extent that income is considered Connecticut source income. The 6.99% is applied to that source, and then we'll actually skip to the next slide so we can see an example of how this works here. So we have 3 equal partners. We have a non-resident individual, we have a resident individual, and we have a C corporation, and they all own an entity that's taxed as a partnership in the state of Connecticut. Under the standard method, the Connecticut source income of the partnership is $150,000. So if we assume the partnership has $200,000 of income, $50,000 is sourced to New York, and $150,000 is sourced to Connecticut. The pass-through entity tax is imposed on the $150,000 of Connecticut source income. That $150,000 is taxed at 6.99%, which results in a tax at the entity level of $10,485. The taxable income of the pass-through entity is then reduced by that payment. So instead of having a $200,000 of income flow up to the partners, $189,515 of income flows up to the partners. So you can see this is where the deduction, the effective deduction works by having the tax shift to the partnership. So each partner is then allocated $63,172 of income on the K-1 that the partner receives. So partners receive a federal K-1 and the showing income of $63,172, and that applies for the non-resident partner, the resident partner, and the corporate partner. Now, what happens here is that the non-resident partner has an allocation of $63,172, which has an allocation of the tax with a credit of 93.01%. That happens for the resident partner, it happens for the corporate partner. For the non-resident partner, the effect of that credit largely depends on what happens in the home state and whether or not they recognize that credit when they file their home state return. The resident individual would get a credit of 9301, which equals the amount of the PET tax paid, which completely would offset the Connecticut tax liability. The C corporation would also get a credit to the amount of the 93.01%. So depending on who the partners are in the standard method, the effectiveness of the pass-through entity tax may vary. Let's actually go through here. So the tax is, or the credit in this slide is allocated on a pro rata basis. We'll get to what happens if you can or can't allocate it on a pro rata basis, but this is how the standard method would work. Again, if all of these individuals in the example, if they're all three Connecticut resident taxpayers, their credit would completely offset their Connecticut source income. Their Connecticut tax liability as a result of their ownership of this partnership would be completely offset, would not be a problem. Less clear for others. Yeah.
So as part of another question that I received quite a bit is, let's say you're a partner who doesn't pay at the top 6.99% rate, and you're not paying at the entity level the higher rate. When you file your return and you claim that PE credit, any excess credit above and beyond any tax liability you have is a refundable credit. So it is not an increase in the tax rate. It'll purely be a true up at the end. Say if you have the 6% rate, you'll still pay tax at 6%. You claim your credit that you received from the PE. If that amount exceeds it, you'll get that money back when you file your 1040.
Right, we're going to talk about that a little bit more later, but that is true for individual taxpayers. Corporations don't get a refund. Corporations get to carry the credit forward into subsequent years, but it is a refundable credit for individuals.
Yeah, just an observation here, we use the term Connecticut sourced income. So that is something that is throughout these methods, is that the pass-through entity will have to determine what its Connecticut source income is, which is a term of art that's used in the individual income tax world. So whether you have a C corporation owner, a resident owner, individual owner, the entity is still going to have to determine its so-called Connecticut source income. And there's all kind of rules around what that is. That's not part of today's discussion, but that is another term of art that's needed to be understood to calculate this tax.
Yeah, particularly those of you who work with companies that have multi-state businesses of one kind or another. Obviously, the kind of side note here is those rules changed as at the beginning of 2017 for pass-through entities, and it's very important that you kind of have to apply those rules in this context and sort of understanding ultimately what's subject to tax here, because that's your starting point, is to discover what, first determine what Connecticut source income is, much in the way you have in the past for purposes of an allocation as well to your partners or your owners of your pass-through entity. You have to still do that, but that will then be the basis upon which you'll pay the tax, assuming you use the standard method.
And that Connecticut source income is subject to all of the offsets and the deductions and reductions that would be applicable for the personal income tax up at the individual level. Those all apply to the pass-through entity tax at the entity level.
Yeah, so there could be issues on determining that, especially when you deal with apportionment issues. We see that a lot as an issue, so it's just something to keep in mind that it's another term of art. You have to determine what that amount is. Okay, so alternative tax-based method. This is probably the method that's going to be, it's an elective method. You have to elect it, we understand, by checking a box perhaps on the tax return. It's not a separate form you're going to have to file with the DRS, is what they're thinking. But it'll be a box on the return, and you have to check that box. If you don't check that box, then you're deemed to be under the other method. So you have to be careful about that on your tax return if you elect this method.
Which is an annual election.
Right.
So
I think it's an annual election. Yeah, it's not like.
Page of the return.
Yep, it's not.
Checkbox.
Yep, it's not like the old combined return election. If some of you file combined returns in your corporate world where you're locked in for 5 years or whatever. This is you can go back and forth every year on this one right now. So the alternative tax base, it's basically composed of, you can visualize, it's going to be composed of two calculations. One is called the modified Connecticut sourced income, which is, we'll get into that, plus the resident portion of unsourced income. And that is equal to unsourced income times the resident ownership percentage. So you add those two together, and we're going to go through an example, and that's what your taxable base is going to be, that you're going to apply the 6.99% to. So it's a little bit more, it's a much more complicated calculation than the other one. But this one would presumably give you a bigger benefit for the federal tax deduction, and it excludes income that's attributable to non-individuals. So if you have a corporation that's involved or an ESOP that's involved, it would exclude from the taxable base income attributable to those non-individual entities. So you wouldn't have to pay tax on that. So MCSI means the Connecticut sourced income, again, we're back to what Connecticut sourced income is, times the individual ownership percentages, or PE percentage owners to the extent owned by individuals. The presumption is that an owner is an individual unless you know otherwise. Okay. So here's an example. If the PE's Connecticut sourced income, as would be computed under the personal income tax law, okay, again, term of art, is determined to be $100,000, and it is owned 25% by a non-resident individual, 25% by a resident individual, 25% by a corporation, and 25% by an ESOP, then the MCSI is $50,000. So you're going to take your Connecticut source income, which is $100,000, times the percentage that's owned by individuals, and that's $50,000. So your first part of the equation is $50,000. Okay, so that's pretty straightforward, unless you have tiered entity structures. It gets a little hairy because you have to figure out what your indirect individual owners are, if you know what they are. So the unsourced income, which is the second part is of this equation, is you're trying to figure out what the resident portion of unsourced income is. So you have to figure out what your unsourced income is. And unsourced income is basically income that's not sourced anywhere. It's not sourced into Connecticut, or it's not sourced to another state. Okay, so UCSI means the total separately and non-separately stated items of partnership and S corporation income, plus or minus modifications, minus the Connecticut sourced income that you just determined, and minus other state sourced income. And we'll go through an example of what the formula looks like. The interesting thing here is, so you're basically taking your Schedule K of your partnership and your Schedule K of your S corporation tax return, basically taking the bottom line taxable income number there, and that's going to be your starting point. Then you add back your modifications like bonus depreciation. Connecticut is decoupled from bonus depreciation, so you have to add that back, for example. Then you're going to subtract out your Connecticut source income, which we just determined over there to be $100,000. Then this is where it gets tricky, minus your other state source income, because again, we're trying to figure out what your unsourced income is. So we have to subtract out your other state source income. The tricky part here is that the way the other state source income is defined, and Matt could chime in here, it's based on a jurisdiction to tax standard, not a subject to tax standard. And there's a slight distinction there.
And I guess I'll,
Go ahead.
this the legislation, and we're looking into if there's ways we can administer it that are as simple as possible. So we're looking to see if there's, obviously trying to figure out what the percentage of sort of tax in each state may be complicated, and at the IRS we're looking at, is there a way that we can put something there that provides some sort of, we say administratively, this would be acceptable for the calculation. So,
Okay, you think you'll put guidance out on that?
and we're still working it.
Okay. Yeah, so the way the law is written now, technically, is that under, subject to tax standard basically means everywhere you're filing a tax return. So if you're filing a tax return in New York, and the other point of it is the way you calculate that other source income is under Connecticut's apportionment rules. So if you're filing a tax return in New York, you're clearly subject to taxes there. So you would be able to subtract out your New York source income using Connecticut's apportionment rules. So you can't simply go to the New York tax return, perhaps, and subtract out.
And maybe it makes sense just to kind of give the why here.
Yeah, go ahead.
The why here with this subtraction is, let's say you're a partner in a Connecticut partnership that does business in Connecticut, Massachusetts, and New York. And you, as a result of that partnership, you earn source income, you file returns in Connecticut, New York, and Massachusetts. But that partnership has income that is from California sales. It's from other types of income that is not sourced income. It wouldn't be subject to tax in New York or Massachusetts. So as a result, if you're a Connecticut resident, you're going to be subject to tax on all of your worldwide income, plus any credits for taxes paid to other jurisdictions. The idea of this unsourced income piece is to say, look, if you're a Connecticut resident, you're going to have a smaller amount of Connecticut source income, because some of it may be in other states where you're not paying tax. We want to make sure that you get if you'd like, you could elect to get a larger credit, pay the tax on that income that you would otherwise not pay tax on if it's been passed or any tax, pay it under the passed or any tax, thereby getting a larger credit, instead of having a smaller credit and then having a larger liability on your 1040.
Yeah, and I think that's the important point here is again, it's an attempt to provide you with an even greater credit so that, income that might not be connected, passive income of one kind or another, like interest income or dividend income, et cetera, that's not sourced to any particular jurisdiction and wouldn't come under the rubric of Connecticut source income. You'd still like to be able to, have the tax paid against that so you can get a bigger credit against your Connecticut taxes. This provides a vehicle by which to do that, so that even in the circumstance we talked about beforehand, where you've got 3 partners, all of whom have Connecticut source income, but they also have a fair amount of passive income that might not be picked up in the standard method. Here's a method, you can essentially go under the alternative tax basis, pay tax, the PET level tax on that passive income, get the credit and be able to pass that credit through. Otherwise, that income is just going to pass through without the benefit of the credit, and you would be subject to that $10,000 SALT limitation. So again, it's a planning opportunity.
Seems counterintuitive that you actually want the tax to be higher, but
Yeah.
you would benefit by having that.
Yeah.
So this is basically the formula for to calculate the alternative-based tax. You're going to take your simply stated and your non-simply stated items, which are basically your Schedule K and your tax return, add or subtract your Connecticut modifications, subtract out your Connecticut source income, and minus your other state source income, which leaves you with that unsourced income that's not being taxed by another state, that's not, or that's interest and dividends type of income, times your resident owner percentage. So if we go to the example here, it's always good to see numbers. The P's total, so assume the P's total income is $900,000. So there's your $900,000 as a starting point. The Connecticut modifications are $100,000, so maybe that's your bonus depreciation add back. And it's determined that the income source to other states using Connecticut's nexus and sourcing rules is determined to be $400,000. So we are able to then subtract out that $400,000. So we start with the 900, add the 100, we subtract out the Connecticut source income that was determined under step 1, subtract out the other state source income, leaving us with $500,000 of what's called unsourced income. The resident ownership percentage, if you recall, we had a 25% owner, so the resident portion of the unsourced income is $125,000. We go to the next slide, we add the 50 plus the 125, we get the 175 times the tax rate. So under this method, our PE tax is $12,233, and then the PE then gets to allocate, that reduces our federal taxable income, which gets allocated, and then that tax gets allocated to the owners for purposes of them taking a credit on their tax return for the tax that has been paid by the PE. So it's a little bit more complicated. We'll go through a couple more examples just to kind of hone in on it a little bit quickly. You have an S corporation that's owned 75% by an ESOP and 25% by individuals. If the alternative tax-based election is not made, the PE will be subject to tax under the standard method on its Connecticut source income. So here we have an individual and a non-individual. If you don't make the election, you're just going to be taxed on your Connecticut source income. If you make the election, then in effect only 25% of the PE's taxable income will be subject to tax based on that formula. Because again, under the alternative base, it's only the income that's associated with individuals that gets taxed. All right, so.
And then I see there's a query there.
No.
Can you allocate the tax to just the individual, or does some of it have to go, or the P credit go to the individual or ESOP, and it can be allocated just the individual? Obviously, there's no reason to allocate tax,
Okay.
credit to an entity that doesn't pay tax.
Okay, because I had another.
I mean, these types of things, I think, are potentially create a problem if the tax is scrutinized at the IRS level, because the more it gets tweaked so that it is only a tax that is effective for individuals up at the top, the more it looks like, in substance, this is just those individuals paying the tax, right? As opposed to an actual entity level tax. So I think the General Assembly and the IRS are trying really, really hard to make sure that nobody pays a dime more in taxes. But by doing that, unfortunately, it may increase the scrutiny at the IRS level. You know, and how do you respond to that? I don't know what the answer is, but you know, it's there.
There is no good answer.
Yeah, yeah.
Okay, here's just another simple example. We have a partnership that's basically owned by all non-individuals, C corporations, what have you. If you make the election, if you make the alternative-based election, since there are no owners subject to individual income tax, there's no taxable base. So if you have a partnership that's owned by all non-individuals and you check that box, you probably have to file a return, I assume, to check the box to make the election, but there would be no tax due. The effect of separately stated items. The separately stated items, I'm not sure if you're probably not tax people, but there are certain items that are considered listed separately on the tax return, on Schedule K of a 1065 or an S corporation return, because they have have special rules when they flow up to an individual, for example. A couple of the special rules are related to capital losses. So if a partnership has capital losses, for example, that's flowing up to an individual, the capital losses would offset that individual's capital gains. And the most it could offset is up to $3,000. For charitable contributions, there's limitations based on your AGI at the individual level. For purposes of this tax, however, you're able to ignore all those limitations. So let's say a pass-through entity has $50,000 of ordinary income and has $50,000 of capital losses. And let's say it's owned by individuals. Well, the individual would normally only be able to get $3,000 of the losses to offset the $50,000 of ordinary income because of the capital loss limitations at the individual level. So at the individual level, you'd be paying tax on $47,000. But for purposes of this tax, you can net the $50,000 capital loss against the $50,000 of income. So now the PE is not paying any tax. But now the individual will have to make an estimated payment perhaps because of the limitations. Because the individual is going to be subject to $47,000 of income, a tax on $47,000 of income for Connecticut tax purposes. But the PE hasn't paid any tax to give them a credit. So you sort of have to be a little bit mindful if you have large charitable contributions or capital losses, the individual still might have to make estimated payments. The PE tax may not cover the entire tax liability of the individual. So if the individual doesn't make estimated payments, they could be subject to underpayment penalties. So you sort of have to you have these situations, you sort of have to look at both the PE level, make sure their estimated payments are fine, and then also at the individual level to make sure that the individuals, owners of the PE, are also fine under the estimated tax provisions. I think so it gets a little bit more work involved. The other big issue, and Alan could probably speak to it, since he's a partner in a partnership, has to do with, we're a S corporation, so it's going to affect us, BlumShapiro. But guaranteed payments was an issue. Guaranteed payments are paid to partners. Partners cannot receive wages W-2s, so they receive what's called a guaranteed payment for their services rendered to the partnership. And the guaranteed payment is a deduction that the pass-through entity gets on their partnership returns, an ordinary deduction, so it reduces the taxable base. The question was that income that gets paid to Alan or whoever as a guaranteed payment, is that subject to the PE tax? And the DRS ruled that no, guaranteed payments that are paid to partners are not subject to the pass-through entity tax. So what that means is a partner who receives a guaranteed payment can't presume that the pass-through entity is going to pay tax on their behalf on that guaranteed payment. The partner is going to have to make an estimated tax payment, whether he or she's a resident or a non-resident individual. So it's a little bit trickier there with respect to partnerships who have guaranteed payments.
It's a very common issue, particularly in professional partnerships, where you may have essentially two tiers of partnership within the partners within the partnership, such that the more junior partners will receive, instead of a participating percentage, they'll receive actually a flat amount, which is deemed a guaranteed payment, whereas the other partners receive a profit share, a profit percentage. Under those circumstances, the way the statute is currently written and construed, the partners who are getting the guaranteed payments are not going to get the benefit at the end of the day of the credit. We won't be paying tax on their behalf, and therefore they'll be getting credit on their behalf, whereas the partners who are receiving the participating percentages will. Now, again, query as to whether that's, the law may get changed to address that or not, the differential, because you could argue there's not a reason to distinguish between the two sets, but I know for a number of partnerships that's a very, very important issue.
Okay, I don't think I'm going to get any detail here on investment partnerships, but hedge funds and investment partnerships, if you're involved in those at all, whether you elect, and I kind of spell it out here, whether you elect the standard method or the alternative tax-based method could have a significant impact on how the tax is calculated, how the partners are treated. So I don't think we need to get into that detail here, but it's just something to keep in mind. But some detail that could apply, where it gets a little bit dicey, is, we have clients, and I'm sure maybe some of you do, or in businesses that have a huge investment portfolio that's sort of sitting to the side in your business. And the question is how is that investment income going to be treated for purposes of this calculation? Is it going to be considered Connecticut sourced income, or is it going to be considered so-called unsourced income? If the investments are sitting inside the business, there's a chance it's going to be part of your Connecticut sourced income. But if it's a huge portfolio that's not part of your working capital, there could potentially be a position to be considered unsourced income, and as a result, you might get different tax treatments on that for the PE tax. So just something to be aware of if you have that situation, to talk to your tax accountant.
And Tony, this is an issue that certainly has existed under
Right.
the income tax for a while. So
Right.
this is an issue for the PE, but it's not a
new issue.
It's just a continuing issue of what's previously existed.
Right, yeah. But it's an issue that's now going to affect the PE tax. Tiered pass-through entities? Yes.
Yeah, this slide has a fair amount of text, which I'm going to try to cut through by
I'm using an example. So what we're going to talk about is, very briefly, I'm not sure how much application it will have to all of you, but it's the tiered entity issue, which is that you have partnerships with partnerships owning partnerships, et cetera, and kind of how do you work your way through that. As we said, there's sort of two ways of calculating the tax in the first place. So if we use the standard method, we just simply assume for the sake of argument here that A, B, C, and D are each resident individuals. A and B own 50% each of LLC2, C and D own 50% respectively each of LLC3, and in turn, those two partnerships own LLC1. So we'll assume that the LLC2 owns 75% of it, and LLC3 owns 25% of it. So at the end of the year, we find out that LLC1 has earned $100,000 worth of Connecticut source income. If you just simply use the standard method that we're talking about, LLC1 would pay tax of the 6.99% on that $100,000. And then what would happen then is obviously you don't want to have a situation, because that income is now deemed earned by LLC2 and LLC3, is they get taxed again. So ultimately what happens here is each of LLC2 and LLC3 simply reduce their income by the amount of income that had been taxed at the LLC1 level. So again, you make sure that you don't have ultimately that tax through. But now posit a scenario where you have a situation where they're going to want to elect the alternative tax method. You have A as a Connecticut resident individual, B as a non-resident individual, C as a corporation, and D as a tax-exempt entity. Obviously, the tax-exempt entity is turning to the parties here and saying, look, I don't want a tax credit. I don't pay taxes in the first place, so I don't want you paying taxes on my behalf. And the corporation is relatively neutral in this, because they're not subject to the SALT limitation that just got passed by the federal government. So under this scenario, they elect the alternative tax method, again, basis for calculating their tax, and it's $100,000 at that point. Now, LLC1 at that point, by making that election, has to, again, apply the two-step formula that we talked about. The first step is determining what their modified Connecticut source income. Now, in this case, while it's modified Connecticut source income, it starts off with the $100,000 of Connecticut source income. Only two of the ultimate partners here, A and B, are residents subject to, or I should say, are individuals subject to the Connecticut personal income tax. And under that scenario, whatever the share there is of the ultimate income is the only income that's going to be subject to the PET tax. Here, I mentioned before, is they have a 75% interest ultimately in LLC1, so $75,000 would be subject to would be considered modified Connecticut source income. Now, let's assume for the sake of argument that there was Connecticut, or I should say unsourced income. At the end of the day, there's interest income of another $20,000 of some kind or another. Because no resident individual owns the interest in LLC1 directly, none of that gets subject to tax. Under what I was positing is that you have $110,000 total income. Ultimately, they're only going to pay tax on the $75,000 of modified Connecticut source income deemed owned by A and B. So it reduces the amount of income ultimately that gets taxed here. And ultimately what you're going to do is allocate the credits in a manner so that they ultimately flow back up to A and B for purposes of the calculation. But that's why, when you get into the tiered scenario, if you have tiered situations, you've got to pierce sort of through the veil here to figure out who the ultimate owners are. If you don't know who those ultimate owners are, you don't know, you're in charge of LLC1, you don't know what A, B, and C, and D are at the end of the day, you have to treat them as though they're resident individuals. And so the whole 100,000 at that point, 110,000, 100,000 at that point would be subject to tax. So one thing that we got asked a lot, particularly by the real estate industry, was, okay, we form special purpose entities for every building we own. And so we have an LLC over here, we have an LLC over there, et cetera. Some are going to have gains, some are going to have losses. We don't want to have a situation where we have losses that we can't use at the entity level, and gains where we can't offset those gains with losses. And so what the statute provides is an opportunity, so long as there's a commonly owned, they're commonly owned entities, meaning more than 80%. And let me stop back for a second. A lot of you who deal with corporations or with combined returns or unitary returns, et cetera, are used to the concept of being 80% or more. That's the federal test for purposes of affiliation. For whatever reason, under the statute, it's more than 80%. So just be wary of that difference between the federal and state law. But essentially what this allows to do, if you've got a bunch of related LLCs and ultimately what you want to do is be able to offset gains versus losses, is the ability to elect with all of the entities filing that election to file a combined return on behalf of all of those entities. So to take a simple scenario, you've got PE1 and PE2. My wife and I bought a piece of property, rental property. That's doing great. We bought another piece of rental property pursuant to another LLC. Not doing so great. We actually have losses associated with that. And in first case, PE1 is generating $100,000 worth of income for us for the first year. PE2 has a taxable loss of $75,000. If we didn't file separately, we could have a flow through of $75,000 on one side and $100,000 on the other. Now that we've got an entity tax, we're paying this entity tax on the $100,000, which we don't want to do, because ultimately is going to just create a bigger credit than we possibly need. In that scenario, we want to file a combined return where we'll ultimately be able to offset the $75,000 against the $100,000 and ultimately pay the pet tax on the $25,000 and significantly reduce our tax liability. Net losses, this is another one that queries back that Matt a little bit here. And under the standard method, it clearly provides that if your pass-through entity generates a loss at the end of the day for purposes of the pet tax return, you're allowed to carry that forward indefinitely until it's fully utilized. The alternative tax basis method, there's no reference in particular in that description of that statute to whether if you end up with a net operating loss at the end of the day pursuant to that calculation, whether you can carry it forward. And I don't know whether the department has reached a decision.
We have not reached a decision yet.
Okay.
I mean, it's clearly in the standard method, and it is also not in the language for the alternative tax base. So we're formulating a position. Obviously, year one, no one's claiming a net operating loss yet. So dealing with, there's many issues to deal with for 2018. We're dealing with those first, and obviously this will be a 2019 issue that we'll get to.
Let's actually, in the interest of time, we'll go through some examples of how this works. 93.01% seems like an odd percentage for credit, but we'll show how this actually is the right number. So if you have a pass-through entity that has taxable income of $100,000, assuming that's all Connecticut source, we're using a simple example here. The pass-through entity tax is $6,990, so that's the 6.99% on the $100,000. So the pass-through entity then issues a K-1 which would be for all of the members, that would show $93,010 of income that would flow up to the members. The tax on $93,010 at 6.99% is $6,501. Right, so that's kind of the basic mechanics of how the pass-through entity tax would work. Well, the credit that then those individuals receive is 93.01% of the tax paid. So 93.01% of the pass-through entity tax of 6.99 or 6,990 in this case equals 6,501. So you see how that in a very simple situation would completely eliminate the Connecticut tax. Those individuals would have zero tax that they would pay on their Connecticut return, assuming this is all their Connecticut income. So the 93.01% is the correct percentage. There is the DRS has issued some guidance, including OCG-6, that just clarifies that there's no add back of the pass-through entity tax at the owner level on the K1. Now here we'll show a little bit how this, a couple of examples here that I think demonstrate some of the nuances and where this gets a little bit sticky with respect to the credit. So we've got here an example, which is an S corporation that's owned 25% by a resident individual and 75% by an ESOP. The total net income before the pass-through entity tax is $10 million. So the $10 million would be subject to 6.99% under the standard method. Under the alternative method, the only 25%, because we've got a resident individual at 25%, you can eliminate the 75% for the ESOP. So 25% of the $10 million under the alternative method is subject to the pass-through entity tax. So 6.99% on 2.5 million is 174,750. Right, so the ordinary income is then determined by reducing the $10 million by the 174,750, right? Because the entity pays the tax, so it reduces the income at the entity level from $10 million to $9,825,000. That then gets allocated on the K1s up to the members. The resident individual gets 25%, and the ESOP gets 75%. What happens here by electing the alternative method is we'll show you in a minute that unless you can also allocate the tax, I think you can allocate the credit, but if the tax is also not allocated, it reduces the overall income of the entity, and then you allocate that 75-25. But if all of the tax can't be allocated to the 25% member, it doesn't actually completely offset the taxable income of the member. If that makes sense, we'll show a little bit on the next slide how that will work. So this is how does the credit get allocated to the owners in that situation. So we have 25% of the $9,825,000 gets allocated to the resident individual. So that individual has $2,456,000 of income on his or her K1. That is then taxed at 6.99%, which shows a tax liability of $171,696. Now, if the credit is allocated 75-25, then that individual only receives $40,000, $40,634 of credit, which leaves a Connecticut tax liability of $131,000. Does that make sense? See how that works? Now, the ESOP, if the ESOP receives 75% of the income that flows up, the ESOP also receives 75% of the credit. The ESOP is not subject to tax in Connecticut. The ESOP should receive a refund of $121,901. So in this case, it doesn't really work to completely offset the income of the resident individual. Now, if we can specifically allocate all of the credit to the resident individual, in the second example, the resident individual has $2,456,000 of income that's been allocated on the K1 at 6.99%. The tax is $171,696. Now, the amount of the credit is $162,535. So you'll see that the resident individual still owes $9,161. I don't want to get bogged down in the numbers, and they're kind of not easy numbers to follow, but the point being that the total income of the resident individual was decreased by only a percentage of the tax paid. So then when there's an allocation, even of the entire credit, the income allocation is higher unless you can specially allocate the tax, right? So if the whole tax could be allocated to the resident individual, then the ESOP wouldn't have any reduction, so the ESOP would have $77,500,000 of income, and the resident individual would have $2,500,000 less than the entire tax paid, right? And then would pay tax at 6.99%, the credit would completely offset that amount. But we don't know if that's how that's going to work. And the more I think we try and make it work that way, the more I think we run into problems of really the entity's just paying the individual's tax. Is this really an entity level tax if you can completely target the tax to an individual? But we don't know exactly how that's going to work. I don't know if Matt has any thoughts on that.
I can tell you one with the allocation of the credit piece. The second item is the interpretation that we are going to be coming out with, that was that the resident individual can be allocated the entire amount of the credit. I won't speak to the federal issue there. Obviously, questions about specific allocation of expenses, and I'm not going to dive into the federal treatment of that.
Right.
So I mean, that I think is something that we'll need to kind of work through. Even if the credit itself is completely allocated to that individual, unless you can also allocate all of the tax, it doesn't work to offset all of the income. Now, the resident individual is still in a better place than without the credit, but or without the tax, but that remains to be seen how that will work at the end of the day. So.
Yeah, and it really falls in the area of not so much planning opportunity, but planning have to do, which is that if you have a partnership where you're going to be electing the alternative tax basis because you've got corporate owners or you've got tax exempt owners of one kind or another, you've got to go back and look now at your partnership agreement to make sure that you've got the ability to allocate those expenses, most notably the taxes you're going to be paying, on behalf of the partners who ultimately want that credit. Because to get a credit or get those expenses, to make those payments with that person and then that not to flow through to the benefit of that person on whose behalf you pay the taxes makes no sense at the end of the day. But it's something you're going to have to consciously go out and amend your agreements to do, if the agreements otherwise don't provide for that. So. All right, I'm going to talk about estimated tax payments and the metaphysical issue that was raised beforehand, which is how does one pay estimated taxes when you didn't know the tax was there in the first place? So let's just start with sort of the PE estimated tax payment rules. And essentially they are what you've been living with in terms of the personal income tax, and pretty much follow those rules to the letter, which is to say that you're required to make 4 annual payments on the 15th day of the 4th, 6th, 9th days of the 15th of the 4th, 6th, and 9th months of the years, and the 15th day of the first year afterwards. So for a calendar year taxpayer, April, June, September, and January. You pay it just as you did as an individual when you're making estimated tax payments as an individual. And you can pay on the basis of 90% of the PET reported or due for the current year, 100% of the PET reported on the PET return for the prior year. The prior year exception does not apply in 2018, so you can't say, well, I didn't have to pay any tax last year, so I'm not paying any estimated tax this year. Not so fast. You can't do that. So you're going to be applying basically largely based on your tax liability for this year. The other method by which you can use is the annualized method. This is used, again, it just uses an example. Professional firms will do this all the time because our income doesn't come in evenly over the course of a year. You're an accounting firm, and much of your income comes in at the beginning of the year, attributable to tax return filings. Your year is different. In the law firm world, unfortunately, most of ours is back-ended towards the back end of the year. So we'd much rather pay on the basis, individuals would much rather pay on the basis of our income as we earn it during the course of the year, so that we're not overpaying or paying early the taxes we'll have to pay. And then again, you're paying on the basis of the income that you earn. So your April 15th installment is based on the income you earned in January, February, and March. Your June installment based on the income that you earn in April and May, and so on and so forth. So that's the alternative base that you can use. Now the metaphysical question. Obviously, the tax was passed in May. Under the statute, you were supposed to have made an April 15th estimated tax payment under the way the statute is written. Unless you're Hermione from the Harry Potter books and had a time turner, time tumbler, or whatever device she had to be able to go back in time, you could not do that. The DRS understood that and then issued a special notice in June, basically offering you alternative approaches to deal with this. One was to essentially make a catch-up payment, so you made both the April payment that you would otherwise be required to make and the June payment at the same time you make the June payment. That was one method. The third is to pay the 22.5% on each of the June 15th installment, the September 15th installment, and the January 15th, 29 installment. And then sometime between now and when your tax return is due, pay the whatever additional tax you would owe, presumably other 32.5% that would be due. It's the 22.5% plus the 10%, obviously, which makes up the difference between the 90% and the 100%. Or you could do the annualized estimated payments for the taxable year. We do have a query up there as to whether you could use just the annualization for purposes of the first couple of quarters. And again, I don't know whether you have any question about that or not. Or
I don't have an answer for you right now, but I can look into it. I will say that, again, this is a new tax. Take your best efforts to try to comply with it. We recognize at DRS that this is complicated, that it's not going to be simple to try to calculate your tax ahead of time. Certainly, we're doing our best to get guidance out to help you calculate your tax for estimated tax purposes, but obviously we are working with the same information you are and moving as quickly as we can to get out there. I will point to the last bullet there. To the extent that you get a bill from DRS that imposes 2210 interest, we would encourage you to write in to avoid the imposition of it. So if you get a bill that says you owe 2210 interest as a result of underpayment of estimated tax, we have an address. I don't know if it's in the slides, but it's in the OCG. In OCG 6, where you should write in to request relief from that imposition of 2210 interest.
Yeah, and I want to note a typo, I think, was in the edition that got copied early. It references the penalty relief request. It's due on or before December 31, 2019. I think on the earlier slides, which we had to send in early to get copied, it said 2018. So you have that additional time. Obviously, the planning point here is that if you want to be able to take the credit for 2018, you want to pay your estimated taxes in 2018, much in the way you used to do under the old SALT deduction. You try to figure out before December 31st, and while you had till in January 15th, 2019 to pay your estimated taxes, obviously to the extent that you can pay it in 2018 to be able to take the credit for 2018, that's what you want to do. So keep that in mind. The next slide talks a little bit about the payment form. Obviously, the Department of Revenue Services didn't have time to sort of set things up electronically, which you've all been living with for the last few years in terms of making electronic payments. So we had to go back to the Stone Age when you filled out your forms handwritten. We didn't go quite back to stone tablets, but we gave some thought to that. And be able to kind of fill out those forms manually. We are hopeful to have an electronic form available for the by the September 15th payment. So both for purposes of filing the form electronically as well as making the payments electronically, that will be back available. So this was sort of a catch-as-catch-can quickie form that was put together and was used by folks. The one other sort of planning point here that I want to talk about before I get into recharacterization is, and this is a point Tony made beforehand, very often, and I would expect in the majority of cases, the fact that we've moved to the pet tax does not mean that owners of pass-through entities are suddenly not going to have their own estimated tax payment requirements. Again, there's going to be lots of different scenarios where you as an individual, even if as an owner of an LLC, are still going to have to be filing your own your individual estimated tax payments. That's because you're earning separate passive income of one kind or another, you have stock, you have interest income that you're earning, et cetera, obviously that's not going to be picked up with the pet tax that's outside the passive investment entity. You may have a spouse that's earning income along those lines that's not fully taxed. You have to worry about those things. Tony mentioned before, you could have unsourced income that's not going to be picked up, and you're going to have income that may be non-Connecticut source income that's taxed, let's say, by the state of Rhode Island, but they've got a lower tax rate than we do, and so while you get a credit for the tax that's paid, there will still be an amount that's not going to be picked up at the end of the day, even under the alternative tax basis method. So it's going to make your life a little bit more complicated, but a lot of people, reach the conclusion, well, now it's going to be all paid at that level. I don't have to worry about my own payments on my own estimated tax payments. Really, the only place where you're likely to see this in significant, where you're not going to have the requirement potentially, is with non-resident owners. So, for example, our law firm, we have resident partners in Washington, D.C., down in Virginia, Maryland, et cetera, that are partners of Shipman and Goodwin. If ultimately the pet tax is going to take all of their tax liability so that there's not going to be any additional tax liability on their part, then it will obviate the need for them to worry about filing a tax return here. But again, even they've got to worry about the same situation I'm talking about, where the pet tax may not ultimately pick up everything that they're going to be subject to tax here in Connecticut. So, word to the wise. Now, the other part of this, and other benefit, and going to potentially be controversial at the end of the day in terms of whether this tax is going to survive, is the recharacterization approach. Again, the metaphysical question that was raised was, well, Alan, the tax got paid in May, or the tax got created in May. I, as an individual owner of Shipman and Goodwin or another pass-through entity, couldn't, I wasn't aware of it. I did what I normally do. I paid an estimated tax payment in April, and yet I'd love to be able to take advantage of this credit mechanism. What the DRS and the statute is going to allow is for you, for purposes of any estimated tax payments you make for the April 15th, the June 15th, or the September 15th estimated tax payment, you're going to be able to, together with the pass-through entity, recharacterize that as actually being paid by the pass-through entity on your behalf. So let's just take a simple scenario. I paid $10,000 estimated tax payment on April 15th to cover my income in Connecticut, like I have in the past. I can allocate all or a portion of that $10,000 back to the partnership, and the partnership will be deemed to have made, let's just say I say $7,500. The partnership will be deemed to have made that $7,500 estimated tax payment as of April 15th. It'll essentially be taken out of my tax account and moved to the partnership's tax account. Now, the benefit for me of doing that is it will increase at the end of the year the amount of credit that I will get allocated for purposes of against my Connecticut tax. So it, A, will lower my federal income tax for the year, and B, I'm going to get the credit that I'll be able to use against the Connecticut tax. So, as I've said to my partners when their eyes start to glaze over when I explain this to them, is you're going to want to do this. The forms are hopefully going to be available around September-ish again. And you're going to want to do it again, as I sort of say, before the end of the year in order to be able to take that credit. So those forms are going to come out. A lot of people who approached us in June, because again, all of this kind of happened so quickly, kind of were panicking about trying to make that estimated tax payment for June on behalf of the pet. And we said, listen, don't panic. If you're not sure how to do this yet with the pet level, file your June estimated tax payments just like you have in the past on an individual basis, because you're going to get to recharacterize it before the end of the period. So again, it's provided a vehicle to allow people to kind of transition into this. Again, it raises the specter that David talked about as, well, now we're doing this kind of on an individual basis as opposed to an entity basis, but it really does kind of ultimately allow you to kind of do this. I'm sorry, did you have a question?
So in other words, people will be allowed to get both credit for the April and June personal estimated taxes, in essence, what you...
Right, it would allow the pass-through entity to get the benefit of that. Correct.
But how does one actually go, this application, is this the thing that has to be done before December 31st?
Well, it's, the form has to be.
Yes. The form is in the process of being created. It'll be put out in September, and that form would be completed to basically say, look, we're gonna, I'd like to transfer X amount of estimated tax payments that I made over to the pass-through entity.
So again, the forms will come out, the process will sort of be better defined once we get those forms, but that's the general gist here. And again, it's a matter of kind of alerting everybody that that's what's going to happen, because again, you're shifting from a period of time where everybody, you told them roughly what income they were going to have, what they should pay their estimated taxes to, now a period where the entity itself is going to be paying those estimated taxes on their behalf. Is there going to be doubling up and carrying over? Yes, but at the end of the day, even if you don't recharacterize it and both the pass-through entity pays the tax and the individual pays the tax, remember, at the end of the day, you'll have overpaid your tax and get a refund. So again, the process should work its way through, but from a planning standpoint, again, you want to make sure that people understand this process, because the recharacterization ultimately will allow you to take taxes you otherwise would potentially be subject to the $10,000 limitation and convert it into a credit that won't. And so again, it is to your significant benefit. There we go. Again, the issue that we will have, continue to be is with non-residents. And I think I'm going to transition to Tony, who's going to talk a little bit about how the credit will work.
Yeah, so this is the last few slides, maybe another 5-10 minutes if that's okay. So going forward, Connecticut did pass a statute that resident individuals will now be able to attain a tax credit for certain entity PE income taxes imposed by other states. In the past, Connecticut only allowed a credit for residents to the extent that the income was taxed at the individual level. It did not allow a credit for entity level PE taxes. So the tax that's imposed at the entity level by other states has to be similar to Connecticut's PE tax, and I suppose we're waiting for guidance from the DRS on what that means, similar to Connecticut's PE taxes and which taxes would apply. I kind of listed some entity level taxes here for certain states, so I guess we'll just kind of sit by and see what kind of entity level taxes the state has in mind for that credit. Non-resident individual, generally a non-resident individual does not have to file a Connecticut income tax return. If the non-resident individual, only Connecticut source income is from the PE and the tax was paid by the PE. But I think as Dave mentioned, there are certain situations where the non-resident might want to file a return because his or her rate is less than the 6.99%. So he or she may be getting more credit than what his actual tax liability is, and he can get a refund for that excess. Also, a non-resident has to file a tax return if the PE files a combined return and the personal income tax liability would not be entirely satisfied by the offsetting PE credit. So I guess the word there is that if you're filing a combined return, the non-resident individual may have to file their own return as well. We alluded before that this law may not be so beneficial to non-resident individual owners of Connecticut PEs. And that's because there could be double state taxation involved here. In the past, when the non-resident paid the tax to Connecticut, the non-resident was deemed to be paying the tax at the individual level. So the income was being taxed by the individual, and so they pay tax to Connecticut. The resident state would allow you a credit for the taxes paid to another state as long as that tax is imposed at the individual level. There are many states that don't allow a tax paid by an entity. So the non-resident who's paying the tax basically at the entity level now, or the PE that's paying the tax at the entity level, those states may not allow a credit for that taxes paid. So not only is the non-resident paying tax to Connecticut, the PE tax, through the pass-through entity, but that individual is not getting a credit for that tax in their resident state. So in effect, that income could be double taxed. I know the DRS is sort of working with some other states on this to see if there's some kind of way that those states would allow at least the neighboring states would allow a credit for the Connecticut's tax, but it's really driven by the other state's law. I don't know if you have any other insight into that or not.
I
Okay.
can tell you we've been in conversations with other states to discuss. We know that neighboring states are considering similar provisions to the PE tax in their law, and obviously if that passes, that won't be an issue for them. And there's certainly, you have to look to each state specifically to figure out the impact of it. I mean,
Right.
some of them will, unquestionably allow it,
Yep.
some may not.
Right, okay.
At the end of the day, this may be the most troubling part of the law altogether, because if we have an established body of law that if you pay tax in one jurisdiction, the other jurisdiction's more than likely to give you a credit for that income tax that you paid. If we don't have that same kind of reciprocity as part of this new sort of entity level tax, it's obviously a significant problem for your non-resident partners if they end up having to pay tax on that income, both in Connecticut and in their home jurisdiction, wherever that is.
KP, tax enforcement, there's all kind of ways they can enforce, you could pay the tax, I won't go into all the details here. So the financial statement impact, if you issue GAAP financial statements, you are now going to have required to probably have a tax provision on your financial statements, because now it's a pass-through entity level income tax. So if you're an S corporation or a partnership, you never had to book a Connecticut tax expense in the past. Now you will. And presumably, by the time you issue your GAAP statement, you'll have to know which election method you're using, the standard method or the ATB method, and then calculate the tax provision under that method, presumably including deferred income taxes and everything that goes along with FAS 109 tax provision. So the way this is booked, it's booked as an expense. In the past, under the old regime, the payment that the PE was making, if they were making payments for shareholders, was a payment based on was a tax paid on behalf of non-residents, and it was treated as a distribution. So in the past, these payments should have been going through the capital accounts of the S corporation owners or the partnerships or the partners in the partnership as distributions and not as an expense. So in 2018, we're going to have sort of two things going on. We're going to have the booking of this expense in 18, which we'd have to accrue if you're on the accrual basis, deferred taxes and all that. And then on top of that, we might have some spillover from 2017 as being distributions that are being paid in 18. If you pay taxes on extension, or you paid any tax with the extension or after extension, those will be treated as distributions as they relate to 17. But the payments for 18 are going to be an expense. So you just have to be mindful of that. There might be footnote disclosures, so you just don't want to lose sight of that. The IRS's reply, Dave talked a little bit about it. The IRS has been really scrutinizing not so much this kind of tax, but more the whole notion of making of municipalities setting up charitable foundations and making property tax donations and all that. They're really focusing on that. There hasn't been any really anything issued by the IRS on this or any kind of notion percolating that they're going to look at this, but presumably, they could because the way the tax works. So again, we'll just have to hold our breath and see what happens. And again, this is presumably temporary through 2025 unless it gets changed. And then to wrap it up, the DRS has issued certain guidance here. It's on their website. The estimated tax payment guidance is listed there. How you calculate the taxes there. They're going to be coming out with some tax credit guidance on how that 93.01% works, how you can allocate that credit amount to the individuals. They issued a special notice on how you determine Connecticut source income under new apportionment rules, and there's some information about economic nexus, which really deals with having nexus in Connecticut as well. So with that, I don't know if there's any questions, any more comments.
Good question. So, would you recommend that we make our September payment as an individual and just see what happens with the IRS if they're going to 2 payments over, or what do you recommend?
Well, it depends upon your circumstance.
Yeah.
First of all, let's make sure
Yeah.
we separate the two. Your federal estimated tax payments you're making just as you always have. We don't want to, sometimes people get confused by that. In terms of the state, I will tell you, it'll depend upon the mechanics within your partnership. I mean, this is, going to be an education process for a lot of partnerships, so we want people to kind of start to get into the mindset of filing as an entity and those estimated taxes. We know for a lot of people, June, it was just too quick for them. If they're able to do it, particularly now that they'll be able to do it electronically and make the payments electronically, that's a good thing. One of the things I worried about is we make, let's just take again Shipman and Goodwin as an example. We make distributions over the course of the year, and I've now got to chase X number of 60 plus partners all over the map to try to get them to do the recharacterization at the end of the day, which I look forward to with less than full-eyed anticipation. So, starting to work with them in terms of, deducting 6.99% from each one of their distributions, so I start to build up the money so that I've got that there. There are going to be partnerships where, you have a real estate partnership. The first quarter of the year, they sold a huge piece of property, maybe the only piece of property that they owned. And you distributed the funds. Now I've got no money to pay the tax, and I've got to worry about the recharacterization. So the less I have to worry about recharacterization, the better at the end of the day. So, for most partnerships, I'm trying to wean them onto the new process, get them thinking in those terms, getting them to, do withholdings in order to make sure that they can pay the tax and distributions, et cetera. But it's, from partnership to partnership, we're kind of dealing with those situations almost as one-offs more than anything else.
And I think getting to whether or not you wait for the IRS to say something, this is the law in Connecticut right now. So if the IRS comes and says, well, we don't really respect how this works, what that will probably do will be you don't get a deduction at the federal level, but that doesn't have any impact on whether or not the pass-through entity has to pay the tax. It doesn't have anything to do with what's happening at the state level on the tax and the credit. That's all independent of the IRS coming in and saying, well, you don't get a deduction. I mean, that's a separate issue,
But then
right?
there's no advantage.
There's no advantage, but then it's up to the General Assembly to say, hey, we're done with this. But, I mean, this is the law in the state of Connecticut, effective January 1 of 2018.
Yeah, and it's hard to say that the IRS is going to come out with anything. The
Yeah.
one thing that they have sent out a clear message is the use by some states, including Connecticut with the municipal property tax, of the charitable contribution that I suddenly volunteer. And I feel that fondly towards the town of Simsbury that I'm making this charitable contribution to them in return for an 85% credit. No one's buying that. Well, they're not buying it. Quite frankly, we're not buying that as having the requisite donative intent in order to be able to take a charitable contribution. That, I think, is their primary. They've made that very clear that that's the first point of attack for them. As to these other taxes, if I'm them, I'm waiting to sort of see what all the states do before I just make the decision to go after them or not.
There's one issue that you haven't addressed. There's
Okay.
S-corp
Yep.
owners that get salaries, and then at the end of the year, say they take half of their profits as profits of the S-corp. How do they get to recharacterize the payments that they've been withholding, the extra money they've been withholding on the salary versus?
Yeah, we don't know if the DRS is going to allow withholding to be recharacterized. Because right now we've been talking
I would
about
think you would
estimated
have to,
payments.
Especially for larger companies
Well, I
that
think
make a
their
few
wages.
$100,000 that might have, it's only a concern of the penalties that might be.
So if there's concerns with penalties, I would recommend looking at your withholding now. If you think you are over withheld on the individual level, start, reduce those withholdings, start making them towards the pass-through entity tax. Select the annualization method for it, and in the event that there is any penalty associated with it for underpayment of estimated tax, please reach out to us. I mean, we recognize that
So
this
you'd
is.
have to request a waiver.
If you get a notice imposing the 2210 interest. So if you don't get a notice, you obviously don't need to make any request.
But the tension that you're talking about with any S corporation between paying reasonable reasonable compensation and trying to characterize something as not subject to employment taxes. That's usually that's the historical fight over that, is only exacerbated by this, because this is another reason why you'd want to push it into the passive side at a minimum to be able to take advantage of the credit.
As far as, I have a question maybe the DRS has thought of. By shifting the tax to the partnership or the S corporation, you run into a lot of issues that you have under the audit rules, similar to what happened with the Bipartisan Budget Act. You know, what happens 3 years down the road, there's an audit at the partnership level, the partnership underpaid the tax, there's been a shift in partners. What do you do now? How do you allocate credits? How do you adjust down the road for a tax that's now at the partnership level as opposed to a tax that was at the partner level?
You know, we're looking into the impact of the partnership audit rules now, and certainly that'll be a consideration going forward.
That should be fun.
Right. We've been saying, that always had the best of intentions here, but as they say, the road to hell is paved with good intentions. So, welcome to hell.
Any other
questions?
Questions or anything? Yeah, okay. All right. If you think of anything, let us know. Thank you.
Thank you.